The truth about ADP, automatic data processing. Okay, this one's exciting. So, first thing we're going to see when we look at this stock is that they're about a $52 billion company. So, they're pretty big. They went public about 40 years ago, and they've kind of been around the block. And so, because they're so established, they pay about a 3% dividend, which is pretty freaking sweet. If you look at the statistics, that's a payout ratio of about 58%. So bulk of their profits get paid out to shareholders, which is really cool. The revenue, the earnings are very, what you would expect from an established company. They make $13 billion, give or take $14 billion in top line, and that translates into about $2 or $3 billion a year in earnings, which is really great. If you look at the profile, like what they actually do, some of you guys might have heard of these guys, some of you guys might not have. They do like payroll, HR, tax services. And that's kind of like the main thing they do. They pretty much serve like big companies that need that, and that's kind of where most of their business comes from. If we look at finance, they'll tell us a little bit more about them. They have kind of two segments: there's employer services and professional employer organization services, and it's all kind of based off of like cloud-based, like cloud platforms. Nothing difficult. HR, services, software. Basically, they help companies do payroll and they help them do kind of accounting and taxes and kind of boring stuff like that. But it's important because if you don't do it, then A, you're not going to have a company with employees, and B, you get a bunch of trouble with the IRS and blah, 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 blah. So what they do is important. What they do matters. And what they do is worth $14 billion a year in top line to them, which is really great. Right now the PE is 21. If we look at their history, the PE has sort of been fluctuating a little bit. The stock's down a little bit right now. It kind of used to be around the 30s and the 40s, and it's in the back of the 30s right now. So last year it was in 40, this year it's kind of back down, and it's not that big a deal. Like their earnings have kind of stayed pretty consistent over time. If we look at their return on assets and their margins, you're going to notice they have some pretty nice margins because they are a software-based company. You're looking at about 20%, which is really super cool. And then they have a really great return on equity, almost 48%. So the money they take in actually turns into a lot of money for them, which is really great. And the numbers here look pretty phenomenal. And I think it shows you got a good chunk of the float held by institutions. And a very low short percent of float, only 1.3%, which is pretty dope. So the question is, the stock worth 122 or whatever it was at? One thing we see here is the book value is $12 a share, and even for a software company, that's pretty freaking low. I mean, that's a company I'm not a huge fan of. I'm not super comfortable with. I mean, this would be like a $24, $36 stock if I was going to base it off of book value. So that's not phenomenal. Definitely not what I was hoping to see with these guys. And I think if we look at the balance sheet, it's going to become pretty clear why. First of all, top line revenue is great. Cost of revenue increases based off of revenue. All the numbers here are what you would expect. This is a normal, balanced income statement for any kind of big company. Basically, they make $14 billion, $500 million, and their net income is about $2.4 billion in profit. If you look at the balance sheet, this is where things start to get interesting, though, because their revenue is awesome, but I want to look at their cash, and what they have in the bank is about $2 billion, and I guess another 2.5 in net receivables. And for some reason, they just have tons of assets based off of, I guess, profits. I guess this is also stuff they're holding. They only have about $2 billion in gross property, so I don't know where they get this $36 billion number from. It's a pretty big number. It's not goodwill. They've only got about $2 billion in goodwill, so I'm guessing it's from unaccounted for cash. I'm not 100% sure. We'll look at the annual report in a second to clarify that. It's not that big of a deal. And then you got about $30 billion in long-term liabilities, which is really interesting. Another number on this balance sheet that really doesn't come from anywhere. I don't know where they get these numbers. So the warrants, a little bit of a more in-depth look at the report. But besides that, you got about $2 billion in long-term debt, which is basically a year of profit, so basically nothing, because they are based more on being a profit software company. Retained earnings is super big, like $15-17 billion of retained earnings. They're paying like a 2% franchise tax on that, guaranteed. So that's like literally hundreds of millions of dollars that they're throwing at retained earnings right there, which is kind of an interesting decision for their investments. That could really hurt them if they keep paying on it, but it also really helps them if there's a recession and they need cash, and then they have those retained earnings to kind of keep their cash in the bank, which is really, really great. And then since they're so well established, it should be no surprise they have a positive stockholders' equity of about $60 billion, which is pretty awesome. So for me, the one thing I see here that I don't really understand is where they get $34 billion in assets and where they get $24 billion, $29 billion in current liabilities. So if we pull up the report, we're going to basically see kind of looking at this company, and they have gigantic services. They really do serve a lot of companies, over 800,000. I mean, these guys are in Africa, and that's kind of when you know that you've made it. And they make HR and accounting and all that stuff super simple, which is great. I'm sure their software is amazing, and they're like the best ever, which is really cool. But I really want to know is where they get their numbers. And it shouldn't be too difficult. Like, considering they serve so many people, I mean, they've got so many clients that I'm sure it's just I'm guessing, if I go to their site, I don't see a tab that says like pricing or anything. But I'm guessing that these companies, they just very simply pay like a monthly fee or a yearly fee to use ADP, and I mean that's a pretty reasonable thing for data processing. And so I'm guessing a bulk of the revenue is actually recurring revenue, which is really, really good for valuation and really, really great for stocks, because recurring revenue is like the godsend of income. It's literally the greatest thing ever, because once they lock in a client, I mean, I'm guessing there's like a 2 or a 3% chance that they churn away and they quit, because they need to have this software one form or another. If they're going to have it charged as long as the company is still functioning. And so I'm guessing they have a pretty solid stake rate, which is really, really cool. Here's sort of their stock performance. It's kind of matched the SPY for a couple of years now, which isn't great. But we'll see. Last year they did really well, and a lot of short-term options here, which is really nice. Just looking at the overall company, though, it looks like a lot of this is just revenue. And yet here they have, I guess these assets are just assets that they own. I'm not really sure where these assets come from, but considering they've been around for 4 decades, I'm sure they're doing some kind of reasonable accounting to get these numbers and to have these assets. So it shouldn't be too much of a stretch that they have $40 billion in assets when they're taking in $8 billion in revenue every year. I mean, it's not that big of a stretch. Okay, cool. So if we scroll down, I think this is the answer. This is the true answer to our question. So if we look here at this chart, or this graph, whatever, it looks like they have about $4 billion in corporate investments, and then they have this line right here that I was not expecting to see. And this line is funds held for clients. And they have about like $25 billion that they're just holding for their clients, which I think is what they're counting as the assets on their balance sheet. I'm pretty sure that's not their money. And so that's really, really bad, because almost half of the total assets on their balance, their total assets are 41 billion. And of those 41 billion in assets, like 34 just come out of nowhere. And I'm pretty sure that that's this right here. This is corporate investments plus funds held for clients is $30 billion. So like this company is not a financial advisor. They're not investing for their clients. So I'm guessing that this number is like money that they give the company, the clients give to the company, they give ADP to manage. Like, I don't know where the hell this money comes from or what it's for, but for all I'm concerned, this is $30 billion. It is not their money. It's $30 billion that their clients have entrusted to them in the short to medium term. And basically, I think what's happening is these clients, they give a bunch of their money over to ADP, and then ADP takes that money, puts it on a piece of paper, and they kind of call it their own on their annual report and on their books. And I don't think that's right, because this money isn't really there. This is the money of their clients. So it shouldn't be on this report, and I think they're overstating the assets on their balance sheet because of this little accounting nuance, which is really bad. If that's the case, then their total current assets should be about like $5 billion, and that means that their current liabilities would be $32 billion, or $36 billion, which means that their book value would be like whatever the shares are. The value of this company on paper is like negative $25 billion, which is really bad. That's really bad. The float on this company is about 430 million. So if we do some quick math, 25 billion over 430 million is going to give you a book value of negative $58, which is really bad. I don't know if, like, they're just like, I don't know if this is like seriously like what's going on, but from what I can tell, this is $30 billion of money that's not there, sitting on their books, and that's really bad. That could really screw this company over, just based off of that. I mean, yes, they have revenue, and yes, they have income, and yes, they have recurring revenue, and yes, they have really, really great earnings. They're earning billions of dollars a year. But if they don't, like, I don't think have any assets besides their software, and they've got like $36 billion of debt or of liabilities, and I think most of it comes. Yeah. So okay, wait a minute. Okay. So maybe this line right here, 30 billion in liabilities, is the same as this 30 billion right here. So I think what they might have done is they took the 30 billion that came from here from their clients, and they accounted for it as an asset here, and then they took that 30 billion and they accounted for it as a liability here, which means that basically they just put it there so that it looked like they had bigger numbers on their books, and it had a zero-sum effect on the actual value of the company. And if that's what happened, then dude, that is some seriously sketchy ways of accounting to make it look like your company is worth more and to make it look like your company has more debt. And like, I don't know why they would do that. Like, that's just really weird. Yeah, that makes no sense. That is some seriously sketchy company, man. Like, that's like Deloitte audited this. I don't know how they let that happen. I guess Deloitte didn't audit that. They audited the following parts. They audited the revenue reports. So I guess Deloitte didn't audit the fact that they have $30 billion kind of just added onto their books for no reason whatsoever. Which isn't good. I mean, that's seriously overstating this company in one way or another. So yeah, right here, funds held for clients is 30 billion, and that isn't in Yahoo Finance. That's really interesting because this is money that's literally not there. So why do they have this on their sheet? It's beyond me. This is a serious bypass of generally accepted accounting principles. I mean, this is bad. Like, these guys have 30 billion that's just not there, sitting here as a liability and sitting here as an asset, and like, that's inflating their books for no reason. So don't really know why that happens. If I look up like client funds and try to figure out what these actually are, like why they have these in their books, I mean, it looks like they purchase client funds marketable securities, but these guys are not in the securities management business, so it makes no sense for them to have this. It says right here that funds held for clients represent assets that are restricted solely for the purposes of satisfying obligations to remit funds to the company's payroll and payroll taxes. So basically, it sounds like this is an accounts payable account that's not being used for accounts payable, which is just really, really sketchy. I mean, that's seriously messed up accounting right there. Here we see it again, money held for clients are contractual obligations to pay the company. I don't know why they would do that instead of accounting for it as a purchase order or accounting for it as a just an accounts payable expense on accrued liabilities or accrued assets. Like, there's no reason to have this really sketchy accounting because, like, last I checked, this company is not an asset managed company. There's no reason that they should be dealing with securities, which they say right here, marketable securities for their clients. Like, there's no reason they should be dealing with that. That's not what they do as a company. So I have no freaking clue why they have this asset, this division of their company. And if they are investing in securities, then this recession is going to freaking crush them because those assets, if they're invested in like the market, like they just lost 40% of their value. So they just lost like $12 billion in assets that aren't even theirs if they're investing their clients' money. That makes no sense. And that's like a third of this company's book value gone, which is kind of really, really messed up. I mean, hell, they're putting this in mortgage-backed securities. Why are they invested? They're investing. Guys, look, this is not good, okay? This is really not good. They should not be investing in any universe in mortgage-backed securities with money that isn't their own in a market that is fundamentally tied directly to the stocks that's going to go down the instant that we hit, recessionary monetary policy. Like, this is seriously fucked up. Like, there's no reason for this segment of their business to be totally separate from what they do with HR and payroll and accounting and stuff like that. Like, there's no reason for this asset management to exist. Like, I think somebody was seriously messed up with this company when they did this because, like, there's a legitimate oversight into the validity of this company's accounting and the way that they manage their clients. I mean, this is messed up. So, yeah, they call it short-term financing. And I mean, this is seriously short-term financing. It's available for sale securities. Like, unless they're getting paid in stock, which would make no sense, like, they shouldn't have these securities. It makes no sense. This is not part of their company. And so that's kind of one thing that really puts me off about these guys is this is some seriously sketchy accounting. It does not make much sense at all. Besides that, everything here is pretty normal. I mean, you got assets, you got liabilities, you have revenue. They're selling software. Software is a proven industry. I mean, they should do well. If the market does well, they should do well. I mean, like, if I'm just thinking about this logically, a company's going to need HR and they're going to need payroll no matter whether they're making more money or making less money. So really, I mean, they're going to have different levels of based off of the number of employees they have and stuff, but I mean, these guys should not be affected too much by a recession unless a lot of firms close. If a lot of firms close, they're going to get crushed pretty hardcore. I think really the deal with this stock is that it's based off of public perception. Like, the movement here is really based off of public perception because the underlying company isn't that volatile. So big swings in the stock price are really just going to be based off of markets and public perception more than almost anything else. It would be just because of the nature of their business. I mean, everyone's going to pay their taxes every single year, hopefully, whether or not the market goes up or down. Hopefully. But yeah, I think that's probably the biggest takeaway from their annual report is they have some serious sketch accounting. So going over to the stock, now that we understand what we're getting into, they've had a pretty hard drop recently. They're down to the 50 monthly moving average, which is the 200 weekly moving average. And if we look at what they did in 08, what's cool is that they consistently pay their dividends. So, like, in the long term, these guys, I mean, they look pretty solid. They have tons of cash on hand, and they basically have never missed a dividend payment, which means that, I'm not freaking out about a 3% dividend or whatever. But what I am saying is that they make really consistent money, and they're a really, really reliable company in the long term, which is great for overarching growth. They are highly correlated to the market. Their beta is 0.9, and we'll add a comparison here. If we compare it to the market, they're basically mimicking market performance with a little bit more inherent risk just because they are just an independent company. But they didn't have that big of a downturn in '08, and they kind of bounced off this 200 monthly moving average. And in the long term, they have drastically outperformed the market, which is really good to see. I mean, even in the short term, they've outperformed the market. So, I mean, really a solid company here. They're very correlated to the market, but they have definitely outperformed it. In 2008, these guys went basically straight to their 200 monthly moving average, and they lost, I think, 3/4 of their value. Yeah, they went from 50 to 25, so I guess they lost half of their value. The dot-com bubble, and then in '08 they went from 40 to 30. They weren't as high in '08, so that's kind of less important, I think. I'm thinking just based off these two previous crashes, this stock shouldn't have that difficult of a challenge going to like $77. I mean, pretty easily I can see these guys going to 77, which is kind of between this moving average and this moving average right here. They just had a really big MACD crossover. They've never really had this big of a MACD crossover except in the dot-com bubble and in 2015, but it didn't invalidate 2015. Right now it's validated because it's an entire market recession. So just looking at like moving averages here, we're looking at about a $77 target conservatively. You can also look at the stochastics here and the percent fee. I think are going to be really useful. You know, just looking at stochastics alone on the monthly charts, this is kind of more a monthly trade. They're still really high. So if we kind of transitioned over to the weekly, we'll see that you got a stochastics cross below the 50, coming into the 20, and they're breaking sort of into the moving on the weekly. And they just had this crossover on the MACD, crossover on the MACD, crossover on the MACD. So the question is, are they going to continue to drop below the 200 weekly moving average, or are they going to consolidate? And that's really the big question here is what's next for this company based off of holistically, like, are they going to consolidate, or are they going to go straight down, or what's the market going to do, and more importantly, how's that going to have an impact on this stock? So here also the percent fee on the weekly is super kind of low. But if you look at it on the monthly, you're going to see that it's basically doing what it did in 2008, where it goes down a bunch before the crash, and then over the next 4, 5, 6 months, it actually has crashed. So with that said, this stock reminds me a lot of NVIDIA, and I want to draw a parallel between these two charts because I think it's going to help you understand what's happening with it a lot better than I can kind of explain it once. Because basically, there are kind of two options. Let me kind of get rid of this real quick, and I'll get rid of this. There's two options of what's going to happen to this stock in the next 6 months, and they're very simple options. The first option is that the stock just like continues to go straight down, and it goes to like this price right here, and it just tanks, and it doesn't stop at all. Now the second option is interesting because the way the market is right now, like this is actually kind of likely just because like everything is tanking super hard, but it's also really aggressive. So our second option, and what else could happen here, is that the stock comes down to here and it kind of bounces around a little bit for about 4 months, maybe 2 months, and then it goes straight down to this price target. And it would probably go a little bit lower if this had this consolidation, just because it's a bear flag. So you can take this and you can add that to the breakout point, and you're going to get a lower price target right here at the 200 moving average for the monthly at about $66. And I remember I first saw this in NVIDIA because this is basically what I like to call like a rock face, or like a waterfall, where it's basically just like a gigantic face of red, and it's just a huge drop in a short amount of time. And I remember I saw this in NVIDIA, I think it was 2 or 3 years ago. God, it's been so long. Let me pull up the chart real quick, I'll show it to you. Is here you can see kind of a really similar setup with NVIDIA, and I'll pull up the weekly chart so it's easier for you to see, but basically you have a massive drop in a very short period of time, and it just goes straight down afterwards. But there was, for NVIDIA, a red setup where it was a little bit of consolidation here, and then it fulfilled the final parts, the setup. So that's what I kind of think we're looking at here with ADP, is it's going to go straight down, and it's probably going to happen, especially if you look at the weekly chart. And just again, remember our price target here is like $66, $77. We're going to have like a red, green, red setup, kind of like what NVIDIA did, where it has this setup, hopefully, and then it kind of fulfills the rest of this price target. So it goes down a bunch, it has some consolidation, and then it goes down the rest of it. The price here is the amount it goes down here is the amount that it goes down after the consolidation. So the initial downtrend is the same as the afterward downtrend after consolidation. Very, very basic, short-term, quick bear flag, and it just works really, really well. I think that's what we're going to see here with the stock. So the question is, are they going to go below? I would say what? Like, let me pull up the chart on TD. It'll be a lot easier to see. The question is, are they going to go below like probably 115 in like the next month or not? And as soon as they hit like 115, I'd say I've been looking at buying some puts, 2 months expiration out, 3 months expiration out with a target of 77. So if you do this at a straight equity play, you're looking at, I guess, about a 50% or 100% profit. About 100% profit. And if you do it with like 2 month out options, give or take, just as an example, right now the setup's not complete just yet. I definitely want to see them hit 115, and I'm going to write 115 down because I really don't want to forget that because that's a really important number here. As soon as they hit 115 though, you should be able to do like 2 or 3 month expiration outs for puts. The May ones that are near the money right now are like $10 for 120. So I would go a little bit out of the money because you're looking at about a 77, we'll call it $80 target for easy math. So that's about $20, $30 in inherent value. It's tripling. No. So 20 plus 30 is 50. So that would be a 5x return at the 120 strikes near the money. But what's cool is if you go out of the money and you just go to like $100, all of a sudden you get $4 puts, and they're gonna have an inherent value of 20, and that's also a 5x return, so not too great. The 110s are $7, and that'll give you an inherent value of about 30. So 30 by 7 is gonna give you about a 4.5x return, which is about the same. It's not as good as anything else. The 85s are like $2, and that's going to give you about a 4x return. So I guess no matter what way you look at it, you're looking at about a 4x to 5x return on this trade. You can get 115s, which will have an inherent value of 35. Divide that by, I guess you're looking at $8, $9, 950 contracts, and that's about a 4x return, adding in time value. So yeah, this is a pretty solid play. It's a pretty reliable play. You're looking at like about a 4x return here, which is kind of at the edge of like things I would recommend trading for options and short-term puts. If you want to do it the conservative way, you could do straight equity. You would double your money on the put, and you could do a stop loss at like 132, which is about an 8% stop loss, 100% upside, which is awesome. And I mean, besides that, if you look at, I guess, so 120 to 70, I guess that'd be 50%. So it's about a 6-to-1 risk-reward ratio, which is really, 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 really good. And then with the options, you're looking at about 4 to, you're getting a 4x upside, but you're risking everything. So I would want to see it tight. It would have to be a quick trade. It would have to be a super tight trade. I would set a stop loss at about 128, which is about another $10 movement in the stock. So you're looking at about $3 change in the value of the options here, which is about a 33% max loss. I think that's pretty reasonable. You're looking at a 33% risk with a solid stop loss at 7, or I guess we do 115, the stop loss at 5 or 450. And a target of about $80, 77 aggressively, 66 if you're crazy. And that should give you about a 4 to 6x return on those puts. In about a 2-month time frame, assuming consolidation on the weekly, which should take place probably over the rest of this week, give or take, and into next week. And so, in the long term, this company is super sketchy. Not a big fan of them in terms of just the way they do their accounting. Really weird guys. Not a big fan of the industry that they're in. I think they could kind of easily be replaced by computers, and they could also have some pretty harsh competition because this is pretty much a race to the bottom in terms of PR software. So yes, they have 800,000 clients, but if someone new comes into this space, I think you have a lot of risk on them getting taken over, or their clients moving to somebody else, and it just doesn't look like it has the kind of returns that would be needed to stabilize itself in a long-term portfolio. And again, compared to the S&P, they're just so highly correlated that it doesn't make sense to make an individual play on these guys, because you could just invest in the market and get like 3/4 of the return and like an 1/8 of the risk. And I think that's really where the stock kind of tittles away, is it just doesn't have anything about it that makes it an independently good investment away from an index saving. And so because of that, I just can't see these guys as part of an overarching long-term portfolio in any kind of regard. But in the short term, these guys look dope. I mean, you're looking at a 4x return, 5x return on puts here, which is awesome. I mean, just really, really good. Like, it's freaking phenomenal. And so yeah, I would take that trade. I'm thinking we'll do that trade. Let me add it back real quick just to see what it looks like. But I mean, as long as these guys consolidate for the rest of this week and they kind of close below like 130, then yeah, I'm gonna be in puts on these guys. Probably whatever strike price makes the most sense when I enter the trade. But I mean, below 120, 118, maybe 117 conservatively, like 115 if you're really, really conservative. It's gonna limit your upside, but not by that much. If you say 115, I mean, they should go straight to 80, and I mean, within a couple of months, or maybe like 6 weeks. I think that's really the big play here on ADPs. At the moment they hit 115, they are basically fucked, and you can really capitalize on that to the tune of about 430, 420%, give or take, which I think that's really the big play here with ADP. So really cool stuff. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learned a lot about them. Now, what's cool is if you have an investment that you think could look really, really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is if you leave a comment down below with the ticker of the stock, I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out, or when these new stocks do come out, you'll be able to get, YouTube will know to send you the stuff, and if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now, or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very, very high-level seminar I gave. The students literally go through and in their first month make 5 figures, and I can't guarantee anything, but I know for a fact that this stuff works, and it's gold. What I want to do is I want to give you this course I used to sell tons. I want to give it to you completely for free, so you can learn the top 35 secrets that you can use within the next week to really, really crush your portfolio, really double it, and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com, and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the masterclass. Thanks. Bye.